What is the good investment in real estate?
Okay, so basically, what we understand from the past, some of my favorite singers and performers on TV, billionaires in the past, all of them took their money, some of the smart ones anyway, took their money and put it into real estate to grow their fortunes. This is why Matthew Perry, who died in Friends recently, but he was the second richest of the Friends because he put his money into real estate investment. So I'm just giving you an example. This isn't by chance. Smart people understand that real estate can create wealth, and you have to understand what's separating a good investment from a poor one. So that's what we're going to talk about, some metrics that you can use to understand how it works.
Exactly. Therefore, this matrix that we're going to give you different methods and factors is going to help you to understand what's exactly going on if you wanted to understand if these deals for investment in real estate is good or not good.
Okay, so we're just going to throw some terms at you as well. So we're going to go with, first one is going to be gross rental yield. This is a measure of income generating potential. It's total annual rent divided by the property price expressed as a percentage. So you want to give me math?
Like, let's say if you in 12 months you get a rent from a property and it sums up, the gross is going to be 20,000, and you purchase 200, you paid for that property 200,000. Therefore, 20,000 divided by that 200,000 is going to give you the 10%.
Times 100 equals 10%. Because you 0.10 times 100. Yeah. Anyway, net rental yield is another common calculation we see. This goes one step further in taking operational cost into association with the property. You want to give me an example?
Exactly. Therefore, if you have the operation cost like a property management or vacancy or any
Not
maintenance.
vacancy,
Maintenance, I mean, you need to take consideration is let's say you have the gross amount of 20,000 minus this 5,000, which brings us to 15,000 divided by $200,000 that you paid for the property, brings us to 7.5%.
Now, the cap rate is a little bit more detail oriented. It's not necessarily the net rental yield. It's going to include the maintenance, the management fees, and the vacancy rate. So net rental doesn't always take into account vacancy, but this one does. So when we're taking rent minus expenses, and it's going to be, again, well, how's the math go with that one?
Exactly. The math again goes with that 20,000 minus the 5,000 is going to be 15,000, and divided by 200,000, the amount that you paid for the property is going to give you 7.5%.
Now let's talk on the cash on cash return. Another very common thing people talk about. This metric is the actual cash you used from your own pocket that you put into financing. We're going to give you the math on that once we do our introduction. Let's hit it. Hi, it's Alan Victoria. Welcome to our channel and podcast.
And if this is your first time in our podcast and YouTube channel, make sure you subscribe and get notified.
Also, you call text all the time, 252-327-3357. We love talking to you. Don't be shy. Also, grab our buyer's guide and seller's guide in the description below. Now, want to give us the math on cash return?
Definitely. Therefore, on the cash on cash, let's say you put $50,000, which is cash, for $200,000 a house, which is 25%. And then the property makes you $5,000 after your expenses. Again, we can go to the previous example that we said. That $5,000 divided by $50,000, which is your initial investment of 25% on the purchasing a $200,000 house, gives you 10% cash on cash.
So the next thing we're going to talk about is your internal rate of return, the IRR. This is a more comprehensive one. We cannot give you an example because you need financial software in order to run an internal rate of return. But I would definitely recommend investing in the software if you're investing into the seriousness of this job.
Exactly.
Now let's talk about our more fun thing, because now we get to talk about the market, and this is really where we really love to shine.
Exactly. Conducting the market analysis to calculate what is the best or what are the choices of the best real estate investment. This is the key, understanding the condition of the market. And there are few steps that we wanted to talk about in this market analysis that gives you whole grasp that what are the main factors playing in this role for understanding the best investment.
So evaluating methods were employment rates. You have to know what your employment rates are in the area that you're looking in, the GDP of the area. Population growth is going to be all signals for a healthy investment return in a regional area.
Exactly. The next thing, and part of these factors, is a neighborhood analysis. Look at the neighborhood analysis like a crime rates, like a school quality, or local amenities, which can affect actually the desirability of the location or area that you wanted to understand the property value in those areas.
The next thing you want to know is if there is any historical data that we can give you from the past. You can kind of look at the history to predict the future. So you can look at the appreciation returns, you can look at the future growth, how many people are moving into the area. There is historical data that you can cling to.
And the next one is really financial analysis. This is also crunching number is the most crucial part of the determining the good investment. And we said all these factors before, like a cash on cash return, IRR.
Well, it's not just that. There's
rate.
calculating the purchase price. You want to calculate the purchase price, closing, renovation, upfront fees, and then you want to do into the operating expenses, which is your property taxes, your insurance, your maintenance, your management. And yes, we used the formulas before, but that doesn't mean that this isn't a financial analysis of what we're trying to do. And then once we have that data, then you can forecast your revenue before you even put in a dime into there. So you want to make sure that your occupancy rates are and your market rents are there before you actually put a dime into this property. What else you want to do with finances?
And assessing the finance is very important too. Therefore, you wanted to know which more, if you're buying the cash, that is easy. But if you're not buying cash and you wanted to finance it, you need to look at the different financing option. What kind of financing option?
I want to know what your interest rates are and your long terms are that you can qualify for, and maybe you are fully buying this as an investment portfolio into your investment portfolio, and you're using an investment loan. You're allowed to do that 100%. You have to just know what your options are, and then you want to minus that income. So you want to make sure that that quality is that home is going to get you income even after that financing.
Exactly.
And when interest rates are 8%. This is something we have to consider.
Exactly. Therefore, the next thing is long-term planning.
Yes.
Now, beyond that, this matrix and calculation that we offered in this podcast and video, you need to make sure that what is your long-term potential for you as an investment? Is there any appreciation in that area? That's why you have the historical data and market analysis. Is there anything that can put your investment in danger? All these things also need to be well thought before.
So you want to have an exit strategy. It's number one. So you want to plan ahead. If you're buying this property for this specific reason and you're going to want to sell that property for a profit, understand when you want to sell that property as well. So plan ahead for when you want to sell the property. So maybe it's going to be 5 years down the line. Maybe it's 10. When is your exit strategy on that property and what are you going to do in its place? So have a plan of action. Maybe you took an ARM and you only have 5 years to make money on that house and then you flip it to another house. So you have to have an exit strategy.
Exactly. The next one is the growth strategy that consider how you can, the ways that you can add value to the property through renovation or improve that management to increase your return on the investment.
And risk assessment is there. Markets fluctuate, interest rates go up, there are changes in the economy, so we have to make sure that we are minimizing our risk as much as possible. So we think these are all just important things you should know if you want to be an investor. These help you make an informed decision, and we love talking to people who want to make these decisions all the time.
And this is Alan Victoria, real estate agent in Greenville and Winterville area, and we'd love to help you and see you in the next podcast.
And don't forget to watch this video.